Welcome to Generation Gains, your go-to resource for making the most out of your money. As millennials, we're often told that investing is the key to financial independence, wealth building, and securing a comfortable future. But if you're like most people, you might be asking yourself, where do I even begin? In this ultimate guide to investing in 2025, we'll break down exactly how you can start, what strategies to focus on, and how to avoid common pitfalls that could derail your investment journey. Whether you're just beginning or want to optimize your current strategy, these tips are tailored for you. Before jumping into any investment opportunities, it's essential to understand the fundamental principles of investing. At its core, investing is the act of putting your money into various assets to generate a return over time. While there are countless types of investments, most fall under one of the following categories: stocks, bonds, mutual funds, real estate, and alternative investments, cryptocurrencies, commodities, etc. The goal of investing is simple: grow your money. Unlike saving, where your money typically sits in a low-interest savings account, investing offers the potential to earn a higher return, though it comes with higher risk. When it comes to investing, time is your most valuable asset. One of the key benefits of starting early is the ability to leverage compound interest. Compound interest is the process of earning interest on your original investment, as well as on the interest that accumulates. This snowball effect means that the earlier you start, the more your money can grow over time. For example, if you invest $1,000 today, with an average return rate of 7%, in 10 years, that $1,000 will grow to about $2,000. But if you wait until you're 30 to start investing, you lose out on that valuable time. Starting at 25 rather than 35 gives you an additional 10 years of growth, which can make a huge difference in the long run. It's important to have a vision for what you're trying to achieve with your investments. Are you saving for retirement? Do you want to buy a home? Or perhaps you're looking to build a nest egg for emergencies? Whatever your goal is, setting clear financial goals will guide your investment decisions and help you remain focused. For example, if you're saving for retirement, your strategy may differ from someone investing for a home down payment in the next 5 years. Understanding your financial goals allows you to choose investments that align with your timeline and risk tolerance. Every investor has a different tolerance for risk, which is an important factor in determining what types of investments are right for you. Some people are comfortable with high-risk investments like individual stocks and cryptocurrencies, while others prefer safer, more stable options like bonds or index funds. Your risk tolerance can also depend on your age, financial situation, and personal preferences. Younger investors often have a higher risk tolerance because they have time to recover from potential losses. On the other hand, someone nearing retirement may prefer safer investments since they have less time to recover from market downturns. One of the most important strategies for beginners is diversification. Diversification means spreading your investments across a variety of asset classes, industries, and regions to reduce risk. For example, you wouldn't want to invest all your money into one single stock. Instead, you could split your money between stocks, bonds, and real estate, and within the stock market, you could diversify across different sectors: technology, healthcare, energy, etc. Diversification helps protect your portfolio from volatility in any one market. If one asset class experiences a downturn, the others can offset the loss. While it's impossible to completely eliminate risk, diversification can significantly reduce the potential for large losses. When the stock market fluctuates, it's tempting to try and time the market, buying when prices are low and selling when they're high. The problem with this approach is that it's nearly impossible to consistently predict market highs and lows. One of the best strategies for beginners is dollar cost averaging, DCA. DCA involves investing a fixed amount of money at regular intervals, regardless of market conditions. This helps you avoid the stress of trying to time the market, and it also means you're buying more shares when prices are low and fewer when they're high. Over time, this smooths out the effects of volatility and lowers the average cost per share, allowing you to accumulate more wealth in the long term. This can have a massive impact on your long-term returns. For instance, contributions to a traditional IRA or 401k may be tax-deductible, lowering your taxable income. A Roth IRA, on the other hand, allows for tax-free withdrawals in retirement. Investment fees can take a big chunk out of your returns over time. Even a small fee might not seem like much at first, but over decades it can add up to thousands of dollars. Look for low-cost options, such as index funds and exchange-traded funds, ETFs, which tend to have lower management fees than actively managed funds. Additionally, many brokerage platforms charge trading fees or commissions, so it's important to choose a platform with low or no fees. Fees may seem insignificant now, but they compound over time and can have a major impact on your investment performance. Investing can be an emotional roller coaster, especially during times of market volatility. It's normal to feel nervous when the market drops or excited when your investments are performing well, but it's crucial to avoid making decisions based on emotions. Emotional investing can lead to mistakes like panic selling during market dips or buying stocks based on hype. One way to keep your emotions in check is to set a long-term investment plan and stick to it. Revisit your goals and remind yourself that investing is a marathon, not a sprint. History shows that, over time, the market has tended to recover from downturns, so it's important to stay patient and stay the course. The world of investing is always changing, and staying educated is key to making smart decisions. While it's tempting to invest based on advice from friends or social media influencers, it's always better to do your own research. Read books, follow credible financial blogs, listen to podcasts, and keep an eye on news that could impact your investments. As you gain experience, be open to adapting your strategy. You may find that your risk tolerance or financial goals change over time. The more informed you are, the better equipped you'll be to adjust your portfolio to match new circumstances. Wealth building doesn't happen overnight, and it certainly doesn't come from a get-rich-quick scheme. The most successful investors are those who stay committed to their plan and allow time to work in their favor. Compound interest, diversified investments, and consistent contributions all work best when you give them time to grow. Patience is essential for long-term success in investing. While market ups and downs can be stressful, keeping a long-term perspective and sticking to your strategy can help you build wealth over time. Investing in 2025 may feel overwhelming at first, but by following these tips and focusing on long-term growth, you'll be setting yourself up for success. Start by setting clear goals, understanding your risk tolerance, and building a diversified portfolio. Take advantage of tax-advantaged accounts, minimize fees, and keep emotions in check. Most importantly, be patient and continue learning about the world of investing. Remember, investing is a marathon, not a sprint. The sooner you start, the more time you have for your investments to grow. If you're ready to begin, take the first step today and watch your money work for you. By using these tips and strategies, you can approach investing with confidence, knowing that you're making informed decisions that will help you achieve financial freedom and success in the years ahead. Thanks for watching this ultimate guide, and don't forget to like, subscribe, and share with fellow millennials who are ready to take control of their financial future.